What's up, everybody? Chris here. We're gonna just review what happened during the week. I think it was a little bit of a fluke. I posted it on my Twitter today that this day was actually unique. What is this? My own health decisions. Okay. I thought this day, April 29th, was a fluke for one reason, that the Bank of Japan had a day off. So they couldn't defend their bonds and their currency. And because of that, with a really weak Japanese yen, they couldn't keep it weak. So what happened? The inverse happened. It gained strength. And I think when they come back next week, they're going to have to course correct things and do their yield control curve, control curve control. So I think they're going to be attacking that. But I wish I would have knew this before London Open. I didn't know about it until once New York Open hit, and by then it was kind of too late. And it didn't really register until it started to drop below my position to where I started to become underwater. I'm like, okay, now I can see why when the Japanese yen is weak and the central bank has a day off, how that's like a risk off period. I never really thought of it like that. But in terms of the credit market, when the Japanese central bank is off and it's weak at the same time, it's going to want to try to squeeze some people out, or at least the central bank, or I don't know, people who are making bets with the central bank of just keeping the yen weak. So I don't know. I'm thinking with all the signals it's given me that it's going to reverse back to where we'll have some bullish kind of signals or strength. But as far as government stimulus and the central bank balance sheet, I think I've heard rumors they're reducing it slowly, and then at the same time, government stimulus, they're talking about it, but nothing's passed. And as far as a black swan event, I think we just kind of had a mini black swan event, which was the Japanese central bank being off. They had a holiday and a squeeze with that, and then the bonds and the inversions are fine. There's no new inversions. The percentage of inversions of the bonds hasn't moved. It's still at 6% out of 60%. So it's not giving any worrying signals of a recession. Gold, it's kind of testing these the monthly market structure break high. So we'll see if it continues. It looks like it wants to drop. It looks like I don't know. It could come back, drop all the way down to here. We'll see. I'm thinking it's gonna come down to retest down here again. But it's looking semi-bullish, so we'll see going into next week. But I mean, until we start seeing, another a monthly close over here. We didn't have a monthly close over there, but until I start seeing a monthly close over there, I don't see a recession happening. I'm thinking this is going to go sideways until 6 to 24 months from when the 10-year and the 2-year inverted. So I'm basically arguing that this pullback that we're having is not a recession. Are we in a recession? I think no. I think we're in a huge pullback, and I think the difference is that it's because of the Fed, and the unemployment's not high. I think the jobs report last was really strong. If anything, it's just the Fed hiking and it being in a election year. And someone said The reason why I'm shorting is because Jerome Powell gave the signal in January, and I think he's right. When they hike, they make the credit market tight. When the credit market's tight, there's not enough money to be put in risk assets, and if anything, they want to go in safe assets, and it's still tight. And I don't think we're going to be in any recession. It doesn't mean we won't still keep going down, and I believe it's going to keep going down, but I don't think it's going to be a quote-unquote recession. I think it's going to be like its cousin. It's a pullback. And until the yield inversion percentage gets over 60%, I don't think it's... And there's too many people expecting a recession this year. So I just don't think that'll happen. I think it'll just be a really big pullback and then a really big spike. Big is very subjective here when I use the word big. And then unless gold starts spiking and making new highs, I don't think we're in a recession. And gold just looks choppy, and it doesn't look like it's super bullish. I think it's just neutral until something significant happens. And I think we need more time to go by from this holiday in order to really see things flush out. And I think you could almost say that from this thesis I'm going to put out. It's more speculative, but it's a little more than the usual, and it's because I'm pushing a counter trend narrative, and I'm thinking it's going to be a little bullish for maybe 5 days, and then once the FOMC passes and this week passes, I think it'll a squeeze will happen, and then the squeeze will be over, and then at the end of the week it'll start to reverse to a more bearish stance. But let me present my case. So why would the S&P 500 reverse? For one, it's at support, and two, I think it's also the RSI. It's highly likely that it could reverse. It's at support. I mean, we're at the monthly ATR support, and so it's likely to reverse. I mean, we've been hitting this low a couple times, but just from what I see in the cycles, so if I were to just follow the diagram of just the system, the current credit market doesn't look bad. It just looks like it's mixed and it's on watch. I think we'll check credit spreads and see if we've moved up any stage. We're still at moderate. I mean, we haven't changed a whole lot. It's gone up for the last 5 days, but I still think it's like moderate. We can get rid of these too, and then move index. I don't think we'll see where it closed. I don't think it's changed a whole lot. We want the noise, I think. Move index or unique tickers. That's what we want. So let's put this back. Unique tickers. Move index. So, I mean, it is looking a little more bullish, but I think more for just a downtrend. So it did, well, here's one good thing, is that it did not, it actually did a stop hunt. It didn't break market structure. It just did a stop hunt. So it looks like it's going to reach the other side of this. So it means it's going to bring down the fear. So it's more of a bullish sign for the S&P 500 as far as like it's starting to reverse on the fear in the bonds. And then we'll look at the dollar on the noise on the Dixie. And then as far as, see, this is the 1 month. This is 1 day. It looks like it's starting to form a bull flag. Bull flag. So it's got some ways to come down. So there's some dollar weakness. I longed British pound versus the US dollar, took some profit. Wanted to wait till the next week, Monday, to get in some more. We don't know how high it'll go in the British pound versus the dollar, but we do see some dollar weakness coming, and it's going to form some kind of bull flag here, and we'll see how it plays out. I still think the dollar is bullish, but for a small time frame horizon, I think it's going to start pulling back. I mean, it's been going high for a long time, and it's time for it to consolidate. So that kind of supports that. And then the cycles, as far as like the cycles, it looks like we're going to have some upward movement in the S&P 500. I just didn't know if it was going to be this week or next week, but I was guessing like the progress we were making on Thursday was going to be this week, but it looks like not so much. But the RSI is in favor of a bullish reversal. Volatility squeeze, I could see a volatility squeeze in both directions, so I don't have any edge there, but it does look like a squeeze is going to happen. We just don't know which direction. If we were to follow the RSI and like the mass cycles and also the institutional bias being bullish, we could say with confidence that it's more likely to be bullish than bearish. But with the volatility pinching, right now it's like very neutral on the direction on the short term in which it can go. But over just this whole week, I think it's going to be bullish. And if anything, it does look like we could have some bullish divergence with the MACD on the daily and like a downward trend, but maybe a higher low coming on this MACD into the cross of the daily MACD cross of 310.16. So that's kind of just like it's very early signals of just preemptive bullish swing, but that's the best I got with the momentum on the MACD. As far as like a strong swing, we can take a look. The weekly looks far from it. It looks more bearish than bullish. The only thing that's closest to crossing would be the daily and the H4. Right now, I think the H4 is about to cross down. But the daily, I think, has more punch in getting a squeeze in, and if it crosses to the upside, it'll definitely have a good squeeze to the upside. As far as a market structure break, I don't think there's any like significant market structure. Oh, there is the monthly. So we are about to close the month on the S&P 500 come the next market open. And that will turn this monthly into a breaker. So it just, to me, that means, okay, it's further solidifying more downside. And the downside that I'm anticipating is for this gap around 3,400 to be closed. If I were to put a line at the top of the gap and the bottom of the gap here. So that's not entirely like 100%. There we go. Maybe that's more like it. So yeah, around 3,400. Anticipating it. I'm anticipating. So for one, this huge orange box, the big one, is a monthly order block. It's supposed to be bullish, but because this is the close of the month, it will turn into a breaker. So it means that any retest into here, you want to short. And I'm believing that it's going to reach this last week high or this doji candle right at the bottom. And that's where I would like to take a short. But I'm long currently, and I'm expecting it to go, hopefully, to that target. I have no idea, but there's some like indicators to tell me that it could reach there. But I'm expecting it to bullish swing with a huge pinch to clear out some of the bears currently as a stop hunt, and then hit up here, solidify that it's a swing failure pattern, and then come down, because I think we have like a macro swing failure pattern, but then another swing failure pattern again, a macro and a micro right here, and then come down into here around July, and then Q3, Q4 move on up. And I don't know how that's going to affect Bitcoin. Right now, it's not looking the same. This is the monthly order block. We'll see how it happen, what occurs on this coming month. But if it were to follow the S&P 500, I wouldn't be so confident as far as like more bullish momentum. Like, I need to see some proof of reclaiming to the upside. Just holding or higher lows is not enough for me. I need reclaims. I guess higher lows is somewhat of a reclaim, but if it's just going sideways, I don't think so. Like multiple retests of a support is not confidence to me. If anything, it's kind of scary because it's just those bulls. I don't know. They have to keep on putting those stop losses in, and they're having to expose themselves to more and more risk. It just seems less and less likely that they're going to hold, in my opinion, as far as my understanding of how it works. But this market structure break on the monthlies, I would say it's significant to where it's opened more downside. And it's still, in my mind, not considered a recession. I think we're going to see a quick turnaround in the year. As far as the PE ratio in the S&P 500, we're still elevated at 20, and the mean and median are at 15. So it makes sense that we're still overbought in the market. And that's kind of why I'm expecting more downside in the long term. Like within a 3-month time horizon, I expect us to probably reach the bottom in some way and then not flush out until maybe Q3 and near the end of Q3, beginning of Q4, and seeing really good opportunities on everything being cheaper and just scaling in. I do believe, as far as like a decade kind of time horizon, we're in a sideways decade. We're in a lost decade. And I think we're going to see the Corona nuke low, and I'm guessing that will be when we do have a recession, which is 6 to 24 months from when the 10 and 2 year inverted. So we will see, and I'm holding out as far as like investing wise until we do hit that Corona nuke low for the recession. So all I have to do is be patient 24 months from when the 2 and 10 year inverted. Anytime during that 24 months, I should expect a lot of downside. And once it starts happening, it should be obvious other than this year. And that's when I'll have my money ready, the dry powder to deploy. So that's kind of just what I'm thinking. And then as far as just like other things related to that, I showed you the institutional buying, the short-term bullish divergence with the daily MACD, and then my targets. So I showed you just a quick way of how I'm looking at the targets. The quick way would be here. This gap is like a quick low target. As far as like how I find my market imbalances, like I think this is the right one. It's these naked pivots. So we just hit a naked pivot. It took forever because we jumped away from it here, but it finally hit this naked pivot. It finally did. I mean, I've been waiting since we started to come back here. I've been waiting for roughly 50 days for it to come here. It's ridiculous. I've been waiting 50 days for it to touch that line. And I would have a target every time it would come down. I'll be like, oh my gosh, it didn't reach it. Oh my gosh, it didn't reach it. Oh my gosh, it didn't reach it. And it finally reached it. It took forever. But 50 days, and it finally reached it. So now, before the monthly order block break, I was targeting this as a low. And then it would do a swing failure pattern and reclaim into July, into Q4. But now with the monthly breaker, I'm targeting this one around 3,400. So I'm expecting it to go down there and swing failure pattern all the way up. So that's kind of just how I'm thinking about it. And as far as like a high target, I'm doing it on the H1 here. This is the Oasis Trading Suite, and this is kind of how I find the short-term, long-term targets, and I think it's going to be this one right here. Wait, no, it's right here. That's too high. I'm thinking it's going to be this one here, around 45.11, 41, and that's pretty close to the last week high of this week before we hit next week. Last week then. And then how that plays out is if I go to the range here, at Q4, it draws in my my indicator of order blocks, draws in like a swing high and swing low. If I were to put a fib, it gives me my fake out lines, which is this 0.13 here, which happens to be at the monthly open. So that 1 hour naked pivot is right here. It's coming from here, that 1 hour naked pivot, and it's in the fake out zone. So I expect it to like poke its head up over here, reclaim, and then shoot down. That's one thesis. I have no idea if it's going to reach it or not, but it's a target. That's kind of just what I got, and it's the monthly open is going to move once we start the new month. So who knows? But it's a good target. I mean, if anything, if we reach the end of the week and it only got to here, that's fine by me. I would have profit on my positions on the longs. And, if this holds, whatever, it would still all be the same to me. I'll just have the trailing stop get hit, and I'll be in profit, see if I can get some shorts on the way down. But that's, and then why I think it's also going to reverse is that it's at support. It bounced off and did a stop hunt. It didn't close below, and it didn't close below here. So it makes sense to me that it could reverse, not only because of that holiday from the Japanese central bank, but because we didn't have a strong close, it looks like it's more likely to reverse, and we could see a bull flag hit into this 0.5, coming back to consolidate at the 0.618, and then launching higher. So that's kind of just how I'm seeing it playing out. It could totally happen. It could totally be wrong. I'm so early in just explaining this that it's more likely to be wrong, but I'm really putting my bet on the institutional bias and the math cycles of just some kind of bullish pump into 5 the end of this week, and then it reversing in some way. So we'll see. It would fulfill like both arguments of a long and a short, because we're going to have a monthly breaker. The breaker is significant for the bears because it just means it's solidifying that there's a break in market structure of a stronger bearish bias, of more downside. And then at the same time, the bulls and some kind of squeeze to the upside to where we hit resistance at that doji or this last week high, 45.11.41, and where that naked H1 pivot is. So we'll see. All of this are just targets and theses. We haven't really seen it, how it reacts, how price reacts when it gets to those levels. It could totally be wrong, but right now, I'm trying to kind of hold on tight and see what happens come Monday or Sunday market open. Hopefully, we get farther away from that low, and we don't try to test that low more, and the Japanese yen reverses things, and we're able to see more bullishness in the near term up into FOMC. But Good luck to everybody. Talk soon.